it was tremendous how many of the leaders wanted to go from, negative 10% margin to 25% margin because, hey, we're losing money on this stuff. It's like, well, yeah, you've been losing money on this stuff for the last 18 months, and that didn't bother you because you didn't have any idea, what your real cost was. So that's another area to be mindful of as you start to understand and develop your cost and start to apply margin.
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at independent ERP and digital transformation consulting firm Elevate IQ. Unit economics is critically important for product-centric businesses. If you don't understand your true cost, you might be selling at a much higher price, which would mean that you might not be able to win against your competitors. Also, if you are selling at a lower price, as you may be missing on some cost elements, you might be losing money or selling unprofitable products. Product costing has deeper implications on your finance, supply chain, and operations. It could especially be trickier to implement if you have multiple systems involved in the process and don't have a consolidated plan for master data and inventory. So, what are the best practices to implement product costing for a business? How much is too much and how much is not enough? In today's episode, we invited a panel of cross-functional experts for a live interview on LinkedIn who brings significant expertise to discuss product costing, business processes, best practices. We covered many grounds, including several stories related to costing and the implications of poor costing practices. Finally, we covered concepts such as how to ensure the actual run rate of the machines, aging inventory, and the inventory not tracked, how to reconcile inventory when it may be off during the physical and cycle counting processes, how to capture overhead appropriately, and finally, the costing differences in the custom versus commoditized businesses. With that, let's get to the conversation. Hello, everyone. Welcome to today's show. And if you're joining for the first time, this is part of our digital transformation series, for which we meet every Thursday at 5:30 p.m. Eastern. We pick one topic related to digital transformation, and we always have a very exciting panel who is willing to share their insights and wisdom. For today, we are going to be talking about a very interesting topic. That is going to be product costing that nobody has to worry about because your cost is always going to be perfect. So we are going to be discussing very interesting stories related to cost. Before we do that, we are going to start with everybody's intros. I am going to start with my intro. If you don't know me, I am Sam Gupta. I am principal at Elevate IQ. I've been doing ERP and digital transformation engagements for roughly 20-ish years. Costing is obviously near and dear to my heart. As part of Elevate IQ, it is the independent ERP and digital transformation consulting firm. We help our customers with system selection, business process re-engineering, anything and everything that happens prior to selection, but then ERP implementation and ERP project recovery as well. On that note, I am going to move to Chris for his intro.
Thanks, Sam. Hi, I'm Chris Carradini, president and owner of Turnkey Technologies. Turnkey's been in the business of implementing ERP and CRM with Microsoft Dynamics for the past almost 28 years. So costing's a big deal. I look forward to this conversation with this panel. Thanks, everybody.
Okay, amazing. Thank you so much for being here, Chris. Bob, can I move to you next for your intro?
Absolutely. Thanks, Sam. Bob Feathers. I'm with Bindable. We're in the SaaS InsurTech space, providing technology to enable our clients to do alternate distribution of insurance products. But I come here with over 30 years experience in manufacturing, operations, production management, and business system implementations. Glad to be here.
Okay, amazing. Thank you so much for being here, Bob. Dave, can I move to you next for your intro if you don't mind?
Sure. Thanks, Sam. Hey, everybody. My name is Dave Chrysler, and I own an operations consulting company working with manufacturing leaders to help them create the systems they need to grow. And I come to you with more than 20 years in manufacturing operations, helping out with ERP implementation, systemization. So excited to be here. Thanks, everybody.
Okay, amazing. Thank you so much for being here. Abu, can I move to you next for your intro?
Sure. Thanks, Sam. My name's Abu Asif. I am the founder and president here at Pani Management and Tech Corp. Started my career in process and manufacturing before, I have a mechanical engineering background. Then, moved into the business, worked for one of the big four accounting firm in the consulting division, and then started this firm about 12 years ago. We are a Sage X3 partner and help companies in the manufacturing, process manufacturing, discrete manufacturing, and distribution companies all across North America.
Thank you so much
So
for being here, Abu. Mark, can I move to you next for your intro if you don't mind?
Yes, thanks, Sam. Good afternoon, everyone. My name is Mark Lilly. I'm president and CEO of LillyWorks. We help manufacturers solve the late problem, regardless of what ERP system you have. And if you're experiencing the late problem, you know what it is. So I look very much forward to the conversation about product costing today.
Okay, amazing. Thank you so much for being here, Mark. And if you are in the audience and joining for the first time, make sure you guys are going to be posting your questions and comments. We are going to try our best to cover them during the session. If we cannot get back to you during the session, then our panelists will make sure that you get your answers after the session. On that note, I am going to start with the first question with Chris. And the first question is going to be, Chris, as we all know that we have done one episode with you, and you were super structured and insightful in that episode. And that is the first time when I realized that, costing has a little bit of framework. Before that, I used to think that costing is always going to be all over the place. So now, if you are building up on that episode and probably trying to communicate a story related to costing, why costing is going to be important, and if you have seen where costing is probably going to be all over the place, and any implications that you have seen because of poor costing that is done for the organization. Do you want to describe a story?
Absolutely. So I think it's a great starting point. And again, I'm a big proponent of costing, so I have a math degree, so I love the numbers. And we get down to 5 decimal place of precision. Everybody's like, okay, that's important stuff. If we're doing really, really cheap stuff and in high volumes, because rounding is a perspective. But you think about costing, and people don't always understand it, and there's different ways to cost a product. And some organizations focus just on material cost. They're like, okay, it's just material cost. But even if you buy a product and you bring it into your warehouse and you sell it, there's more cost than just material. And most people don't recognize that even the storage space, the labor to move it back and forth, if you really costed it correctly, there's a lot of other layers of cost, fixed, variable overhead. So even just products, there's people that go to a standard costing model so that they can incorporate all those little granular costs in there and actually start measuring the actual expenses against those estimates. And am I close? Am I far? And tweak, and collapse variances. And it's all about refinement. Why? Because we price, we sell. And if that number's wrong, woo! Right? We lose $1 in every one, but we do volume. Sorry, that doesn't work here. So a lot of components to costing, and I'll just use an example where it can screw you up. And I know there's a future conversation about unit of measures, but I've got a horror story a customer did, and it has to do with film. And everybody goes, film? What's film? It's like that cellophane stuff. And these guys were making like bouquets and baskets, so everything used film. Well, again, if you're buying product and you're bringing it in, that's the first point that the cost shows up. And typically when you create the PO, it's dropping some cost on there per unit you're buying that's going to translate into a stocking unit. Well, in this particular horror story, they were buying a roll of film that had inches of film, right? And every balloon and whatever eats inches of film. Well, anyway, when you receive that PO and you create the PO, if that unit of measure is wrong and what's the price? The price per roll, but it got attached to a price per inch. Whoops. And so the magnitude of a mistake in costing like that is repercussion. So imagine consuming and actually booking an inventory transaction with an erroneous cost based on just a misinterpretation of unit of measure, right? If we would have put the price that came in on a per roll, the inch cost is fine. But you put it on the inches, what happens is you got 100 or 1,000 time cost difference on that inch. So instead of a penny an inch, it's $100 an inch. Well, film gets consumed into hundreds of products. Guess what? boom. And all of a sudden, that film that came in at $1.9 million for a roll is now consumed throughout hundreds of inventory items. And if you think about the impact of, fixing things, and so what's that? Let's go all the way back to controls, right? And how do we control, and how do we really make sure that unit of measures, buy, stock are correct, pricing's correct, review points, tolerances. But there's a perfect example how something so simple can propagate through the system and corrupt your costing. Because what happens now, you've got products in there with these high costs, there's negative margins, you're making tons of adjusting entries. So again, there's so much control that needs to be exercised, and really understanding is what is my cost and what are those other costs that you're not considering. So I'm going to stop there. I think that's a good story to get people.
Yeah, so definitely it's a very good story indeed, and hopefully people are going to be scared. And if they are not, I am going to try my best to scare them further. Okay, so I am going to be describing some more scenarios here, and that is going to be related to, obviously, when we look at costing, as you correctly pointed out, that there are going to be a lot of cost elements that companies, they just don't consider. They just feel that, what, it's just too much work. I should not do this. I'm not going to design my BOM the way they should be designed. It should not be mimicking the manufacturing process because that is probably increasing the admin effort. So obviously your cost is going to be all over the place. But one of the major disconnect that I see, typically cost is important because you want to price your product, so you have the appropriate money. Okay, but the organizations that I work with, typically their mindset is going to be pricing is controlled by sales and marketing. Okay, so you have your cost, which is all over the place. We agreed. Now you have pricing, and there is no communication between your sales and finance. So do you see similar scenarios in the businesses that you work with? And what would you say to these businesses when your pricing and cost is completely disconnected?
Well, and I think that, yeah, in the scenarios that sales and marketing can't completely drive it. They certainly can influence based on market competition and say, okay, this is where we need to end up. But I think that you still need the accountants in there that are still rationalizing profitability, because the joke is you can't lose money and you have to have certain margins to operate. And, for sales reps to have motivation, there has to be a spread of margins so that they can have appropriate compensation. So sales and marketing can have some influence, but at the same time, I think that, the finance teams and have to forecast, because forecasting is part of that too. You got to forecast your margin. You've got to, and again, a lot of people do bad math and they're operating. They're like, hey, we're out of business. So it's imperative they do their math correctly. And sales and marketing can only drive so much of that conversation.
Okay, amazing, Chris. Thank you so much for that. So, Bob, I'm actually going to come to you. And last time when we discussed this topic, we had agreed that nobody should be doing a standard costing. So, obviously, you are probably going to build on that because we should not forget that nobody should be doing a standard costing.
Yeah, I mean, Dave will correct me and say that you do it well. You can do standard costs, and I agree with Chris too. I mean, obviously, I think it really depends upon what you're manufacturing, right? And what, if it's really machine based or people based. But I'll let you ask your question, then we can go back and you can tell me where you want me to go with this.
Yeah. So honestly, I'm really looking for these stories, and obviously you are going to have tons and tons of stories related to costing. So I am looking for the specifics where you have seen, because obviously you have worked with a large, corporate house, and there are going to be religious discussions when you are trying to capture the costing. You are going to have implications, but these guys don't listen to you. And because of that, you are actually going to have implications on costing. So tell us the story. Just because of the emotional discussion among teams, your costing is going to be all over the place.
Yeah, so I start with, like, I'm a more of a foundational guy, right? So I'm always like, you've got to build it right.
Yeah.
And so there's two pieces to that. One is really understanding, again, like Chris talking about, understanding what your costs are. There's material costs, there's labor costs. How are those labor costs related to the manufacturing of that product, right? That I'm making that product. What's the effective run rate? Like, how does this thing really run through my plant? What does it really look like? Because again, I think people say, oh, well, that machine runs at 8,000 an hour, but the reality is it's always running effectively at 5,000 an hour, because there are other mitigating factors based on what's going on, which you need to be aware of, right? You need to kind of go in and analyze that, which people just make a lot of assumptions. So that's like one piece. The other piece, I would go into the other side of the costing side, is really understanding the system. Where do the costs hit? When do they hit? When you're running different cost routines, some of those different layers of costing, maybe you just run an inventory value, which is kind of going in and saying, it's going to update my journals. When do I post? But I think it's really, again, it's just, you got to understand when things occur, why they occur, where they're going to go when they occur, and then start to figure out where then those anomalies are when you have the ability to, like, analyze that. Can I have a chance to correct these things before I post my GL? Because once you post the GL, then it starts getting really messy. Because then, if you had a bad cost layer, if you had bad inventory transactions, back to Chris's point, I can share another story about unit to measure that was, astronomical, how it just kind of cascaded across. And it's not just the part cost or that selling price, it was also our inventory. And it was the inventory valuation. And it just started to cascade into this whole thing where you're messing up your balance sheet and your P&L all at the same time. But of course, none of this happened because everything.
So yeah, so very interesting layers there, and there are probably one or two layers that I definitely want to build, and I am going to be touching. Obviously, my favorite topic always is going to be inventory, because again, inventory is always all over the place as well, to be honest. Okay, so here, one of the things that you mentioned is the effective run rate for the machines. And typically, in my experience, I mean, when people enter this data in any of the ERP system, for them, they don't even understand what they are entering. They're simply entering a just random number. Okay, so when you are trying to accommodate the effective run rate of the machine, so what are the best practices that you have seen that you clearly pointed out that, what, I am looking for this machine. The machine is expected to do 8,000, but in reality, it is doing 5,000. So how do you accommodate this variance?
So the best and easiest way, there's two different ways to go about it. The first way, and Dave and I will tell you to agree to this, go out on the floor. Like, you've got to go out on the floor. You've got to have a process engineer, yourself, whoever it is, but you've got to go down there and evaluate the process. Go and look at it and find out. And there might be reasons why, you say the manufacturer says this thing runs X amount an hour. And there might be reasons why it doesn't. And it might be something you're doing, it might be something the machine's doing, it might be something about the product you're making. Because again, it's also about product variations. I might have a product that's a certain substrate, and of course it's going to run through the machine very quickly because it's that's the way it runs. But then a different substrate that is much harder, has a different density, I can't actually get that same run rate. So again, you've got to understand the products, you got to understand how it's going out. But the best way to do it is you've got to observe. There's no other way to do it other than to really observe and understand the process and watch the people doing the process, right? It's just that whole Kaizen thing. You might find out just stupid stuff, right? That the person is spending time to go get something to fix something, and that thing happens to be 150 feet away from them. So they're just wasting so much time. It could be as simple as that. Or could it be that effectively you're making them do certain quality checks? And by doing those quality checks, it just takes time away. So again, just understanding the process. So really it is, you got to get down there and look at it, watch it. And if you find or don't believe that it's right, then figure out what you need to do to fix it to get to where you want to be. Because back to Chris's point, right? It's true, there's a market valuation sometimes for certain products that are commodity. They're just going to say, that's what the market's going to bear. That's what you can sell it for. And if you can't figure out how to make that and make money, then it's not the market's problem. It's probably your problem. And you've got to figure out ways. So if you need to run at 8,000 an hour, you better figure out how to get there so you can be effective at that. So again, there's lots of different ways, but nothing like just going down and observing. That's really where it starts.
Okay, amazing insights there. Thank you so much, Bob. So, Dave, I'm actually going to come to you, and obviously, we are going to be building on the second layer. I'm going to ask your story as well. But along with that, what I want you to cover is going to be the second layer, which is going to be inventory. And when I work with these customers, one of the things that I see is, what? I don't want anybody to be touching my system. Okay, I'm going to have this big giant pool of inventory. That's where everybody is going to be deducting from. That's where everybody is going to be receiving too. So obviously now you don't really have sort of the cost of the inventory, just because everything is sort of stored in one area. You don't really have ways of measuring, the cost. So your costing is probably going to be all over the place. So I don't know if you have seen similar trends from the inventory perspective, as well as if you want to cover your story as well related to costing.
Yeah, happy to. So yeah, to answer your first question, Sam, I mean, yes, on the inventory side of things, I would say what I've seen most often from that's going to ultimately impact your cost is going to be aging inventory, right? And that could be raw material, that could be finished goods, bills release type stuff that doesn't get tracked within inventory. And back to Bob's point, you're out walking in the warehouse and start asking questions. Hey, what's this over here? Oh, that's a job we ran about 18 months ago, and boy, they haven't done any of those releases lately. So it's all of those different aspects that go back into the cost side of things. And kind of my story would really touch on what both Chris and Bob were talking about, and tremendous points from both of them. Kind of my experience centered around a lot of acquisitions. And with these acquisition facilities, kind of to everybody's point, typically what would happen in those early stages would be you would go in and start to ask questions about what their costing methods are, and yeah, we understand our costs, we understand what our run rates are, what all of our standards are. As we're going through the process, pretty quickly you realize that there really isn't any understanding of what your cost is. What you do know is what you're selling it for, and then what margin is left at the end of the day. And the cost ends up just being an actual cost that gets flushed through and is completely variable based on one of a number of parameters that both Chris and Bob kind of laid out. So from my standpoint, getting to the point of being able to have conversations with the leadership teams, going out and inspecting, kind of as Bob laid out, and then really understanding those two layers, to go just a little bit deeper than that, to build off of what Bob was saying, making sure that you kind of have an unburdened machine run rate, right? And then as features of particular products, that could be substrate, that could be, something specific to the actual job, but how those features are going to ultimately impact those run rates, building into where that cost is going to land, and then obviously being able to apply your margin that you need to operate on top of that to come up with what your sale price is. And kind of back to what Chris was saying, yes, that could be some combination of market pricing, or some combination of cost plus pricing. Typically, the other thing that I would see in these acquisition settings is once we started to implement standard cost and understand what our real costs were, it was tremendous how many of the leaders wanted to go from negative 10% margin to 25% margin because, hey, we're losing money on this stuff. It's like, well, yeah, you've been losing money on this stuff for the last 18 months, and that didn't bother you because you didn't have any idea, what your real cost was. So that's another area to be mindful of as you start to understand and develop your cost and start to apply margin and understand what that relationship is. Be very mindful of what the impact is going to be on the customer side of things and ultimately your revenue. And you want to have slow incremental change to ultimately, increase your margins once you start to understand this stuff.
So you actually added a very interesting layer, and that is going to be acquisition. And yesterday, when we were doing the Comet show, we were talking about, okay, when you do the acquisition, we are talking about integrating the customer journeys. Now, that could be a big task. Here, we are talking about costing integration, and that's going to be a tall order as well. Bob has done in his life, and the way he has done is he literally used to run after everybody for 3 or 4 months just to find out, okay, what is going to be your costing? And they actually made him run so much that he ended up leaving ERP world because it's just too much work. So in your experience, when you are going through this journey of the costing integration and this whole translation, that puts a lot of overhead on the finance department. It's not fair to them at all. So when you have gone through this exercise, what has been your experience? I mean, how would you approach the costing integration, especially somebody might be using super legacy methods of costing, and then you are bringing them to cool startup, which is probably doing really, FIFO, not standard cost. So how would you sort of approach the integration, Dave?
Yeah, I mean, it's, first off, it's an extreme challenge, right? I mean, that's the understatement of the year. It's a big challenge. It's a big project and undertaking that you go after in that process. And kind of much like you already laid out with Bob, it really started on the operations side of things to understand what the costs are as we started to build out those models. And then as we were building out those models, refining, we would start to give finance pieces of that to start to implement in the system, and then ultimately kind of allow operations to go through. And it was typically over about a 6 to 12 month period that we would go through and kind of build piecemeal, if you will. We would get a set, kind of get in a work center set up. We would go through all of the standards for that work center, get everything implemented in the system, and then let operations and leadership go through and kind of run through different scenarios, kind of the entire process, right? So job costing to job completion, to understand have we have we done a good job of understanding what we're doing out on the shop floor, and then how does that ultimately relate back to the financials? And for most of those acquisition facilities, we would run kind of dual financials for a period of time to just kind of have that metric, right, to understand that yes, we're either heading in the right direction, or no, we need to go back to the drawing board.
Okay, amazing insights there. Thank you so much, Dave. So, Ebu, I'm actually going to come to you, and I am not going to be done with my inventory topic. So, obviously, I definitely want you to touch on the inventory, and I am going to add a slightly different layer in terms of what I was trying to ask. So,
Mhm.
a lot of different businesses, when they look at the inventory, their physical and digital are always sort of going to be disconnected in general. Okay, there
Yeah.
might be a little bit of variance if that is designed and you understand what you are doing, you have clear cycle counting or the physical counting in place, then it's going to be okay. But sometimes what happens is with these businesses, as I said, they just have this giant iceberg of the inventory. Okay, they don't want to do anything from the ERP perspective because systems should be automated, right? Here, so you have no idea who is drawing which inventory, what is the actual cost of the product that you are withdrawing from the iceberg. So your costing is probably going to be all over the place just because your physical and digital processes are going to be completely disconnected. So that is one layer that I want you to touch on from your experience. And the other thing, if you have any story that you can share, that'll be amazing.
Sure. I mean, it's one of the most common thing that happens, right? You go to every company, and you find that almost everywhere, right? When they're looking at new system, and that's often the driver that your digital inventory and your accounting inventory does not match. The problem it causes is you look in the system, you will say, I'll find this inventory on rack A. You go there, you don't find it, right? And you keep on running around trying to find the inventory. So it's a very common problem. It often that's the driver of improving the system. What we find is the way around that we propose is a lot of people, they will drive, there'll be two issues. Some companies that have a different accounting system and a different inventory system. Matching the two together, good luck, right? It's always the accounting department is going on its own pace, the operation is going on its own pace. The other is obviously the accuracy. Even if you have two different systems, the inventory count is not never accurate. The other thing is the value of the inventory. Your finance system says it's $1 million, but when you look in your ops system, it's never $1 million, right? So and especially when you are a smaller private company and you have grown and you want to raise some bank financing, or you're starting suddenly to become a public company, that's the first thing we ask you to do: match your GL balance to the inventory balance. And that's when they realize, oh, we need a new system. So one of the things that we propose to our customers to go around is the data must always be recorded at the time it's created, right? You cannot say that I'm going to ship this product right now, but I'm going to record the transaction 5 hours later. If you go that route, it never works, right? Because those 5 hours later, you never go back into your system and enter that data. So that's one method. The other thing is the disconnected systems. A lot of people, they prefer to have two different systems because that makes it easier. You don't have to worry about the financial part of the business, right? You can just go in and create whatever stock inventory that you need, right? You can ship it when you want. You don't have to worry about if the financial data is accurate, it's correct or not. So, and then once you have to do financing, that's the first thing they ask for, and that's when you run into trouble. So, we have a lot of stories around it. We had a company who was doing, they had three different, they were an intercompany operation, three different units, large holding company running the financials, and they went public, right? And guess what? The inventory never matched. So what we had to do over there was go back into like 2 years of data, look at each and every transaction, and then try to do guesswork with some, inputs, obviously a little more than guesswork, and try to reconstruct the inventory value, right? And that's always like a nightmare trying to do that, right? And it happens everywhere, in every industry.
Okay, so you brought a very interesting layer there, and I want to touch further on that. So
Yeah.
you are talking about the historical data, and
Mhm.
historical data is another interesting topic that I always like to talk.
Sure.
Now, when you look at the ERP implementations, in my experience, when I look at different customers, they typically go through the ERP re-implementation journey at least 2, 3 times, even if they buy an ERP. So typically, they are going to buy an ERP. That's probably going to happen every 5, 10 years, but then they are going to go through re-implementation. And the reason why that happens is because you hire a consultant You ask them to set up your system. After that, you are on your own. You are going to set up the master data. Master data is going to be all over the place. You will not be able to run the scenario. You are going to call the consultant and they are going to re-implement. Okay,
Yeah.
so that's how the process goes. And obviously, in this process, you are most likely going to lose historical data because it's very, very, very hard to bring that historical data with you. So let's say if you were in the same situation where you are right now, you are trying to get 2 years of historical data and you don't have that, how are you going to match your inventory?
It's very difficult, right? So you have to really look at the GL. Sometimes they don't even record where, which purchase order it's coming from, right? So it's a bit of, a lot of Excel work, looking at the data points, looking at POs, looking at the dates, looking at, you're running through your inventory transactions, running through your GL and trying to find data points to map between the two. It's extremely hard, and you'll never get 100% accuracy. And almost 100% you'll end up writing up or down the inventory value, right? You can only do so much, right? It's 2 years of data, and there are lots of complications around, inventory costs. So, for example, landed cost. You buy a product.
Yeah.
You are, for example, in a food manufacturing company. You order a load of tomatoes to make ketchup. The tomatoes arrive, and you want to use it right away. Right? You're not going to wait 3 weeks. But 2 weeks later, the invoice for the unloading and the loading comes in. That tomato is not even there. So how do you track that cost to that product? So, it becomes very complicated. And unless you have the right systems, from system, I mean the right ERP software for your business need and the right processes, right? From the right processes, I mean, you have to enter the data at the time it's created, right? If you're using it for your manufacturing operation, you have to enter it right away. If you're purchasing it, you have to enter that transaction in the system right away. If you're not doing that, you'll have to re-implement 7 times. So after you go live.
Okay, love 7 times, by the way. Thank you so much for those insights. Okay, so Mark, I'm actually going to come to you. So obviously, you are going to be talking about scheduling. So I am going to give you the question related to scheduling. Okay, do you have any impact on costing related to scheduling? Or if you are not able to schedule properly, would there be any implications on costing? That is going to be a question. And then if you have any stories that you might be able to share related to costing, okay, I would appreciate your insights.
Wow, great! You teed that up beautifully for me, Sam. Actually, I was going to make the connection between scheduling and costing at the end. So if you'll be patient with me, let me go back to the beginning. I do have a story, so let me say that it was actually one of our system users, a customer, and I got this story from someone in the company. There was someone, the owner who was doing the quotes and doing a lot of the sales. He was pursuing this one company to be a customer of his for years, and would issue them quotes every 6 months and this sort of thing. Never get the business, and all of a sudden he got an order from them and got a lot of orders. He said, "Oh, this is great." When somebody looked behind the scenes and they were in, let's just say their product was related to the petroleum industry and the fluctuations of that industry, and they weren't updating their raw material cost. So the situation with the raw material cost wasn't being updated, so their price looked really, really good compared to its competitors, and they got a lot of business, but ended up losing some money, before he realized it. So I'm sure folks have similar stories. I'm going to step back and just be a big contrarian here. As you know, our family and the group behind LilyWorks has created a few different ERP systems, and they all have GAAP accounting in them, right? Generally accepted accounting principles accounting, because you have to, right? In order to sell software, in order to be, and the financial folks are oftentimes decision makers, so of course you have to support GAAP principles. Unfortunately, the unit cost approach, where you're evaluating the cost of a product by not only its material cost but the labor and overhead, right? How is that overhead allocated? If we're honest with ourselves, it's fairly random. And throwing the dart, exactly. And then when you think about the labor, if I make 50 widgets, and there's a cost associated with those, I can't disagree. But if I make 50 more, Does it really cost my company additional labor? Probably not. On a month-to-month basis, I'm paying relatively the same in overall labor and overhead, unless you're in some sort of business that pays people piece rate or something like that, right? And yet we're making significant operational decisions based upon a product cost and a margin analysis, and that's where it hurts, because now you have somebody who may look at the unit cost, compare it to the pricing, look at that margin difference, and do a sort on that. And the reality is, if you look instead at a contribution margin basis, where you look at the material, you look at the sale, and that difference, now you're talking, I have a chunk of labor and overhead, my nut, if you will, that I've got to get over every month in order to be profitable. It's that contribution margin that added up. In fact, every work order I do, every production order I do, I could say the contribution margin of every one of those production orders is directly related to my profitability. But let me ask you, if you add up all your margin, the margin on every work order, and you were to add that up on a given month, would that equal the overall profitability of your company? Not even close. So I think we really have to step back and see what, and there's some really fundamental decisions being made with this information. And you have a much cleaner and better view of where your profitability is going to be and your opportunities to improve that profitability by looking at costing in that fashion rather than the traditional costing method that includes labor and overhead in the unit cost.
Yeah, I definitely want to just expand on one piece that Mark was saying, because it's very true, right? There's this kind of, essentially when I open my doors every day, I have a certain expense, right? Just people come in the door, I'm going to be paying those people, whether the machine's running or not, and whether, so just there's that. So when you think about this in the manufacturing world, we come up with a lot of assumptions. So you kind of start your year out and say, okay, I'm going to have a budget. I'm going to say, how much business do I think I'm going to do this? And what products am I going to make? And how much am I going to sell those products for? And you start to come up with these formulas, and you say, like, okay, here's where I am. And to Mark's point, right, you start to build up, okay, well, this is my average labor cost for these types of input. You can make those calculations and put them in there, what your expected values are. And the same thing with your overhead. But as you're doing it from month to month, and we used to do this, is to kind of, to Mark's point, was we actually measured and said, here's what our budgeted amount of was, kind of what our expected value, and it was based on a certain volume. But if I wasn't hitting that kind of volume of business and the business I needed, then I may not hit that number. So we were kind of watching that number. So we were kind of looking at the units, what we actually did versus what was going on or what we expected to go on. We were kind of monitoring this kind of overall unit cost. It's kind of that overall unit cost of the plant. Like, how much is it costing me? And we might make adjustments saying, like, we don't have enough volume right now. We're not getting the right product mix, or the stuff that going out the door isn't the right cost. And we're kind of trying to at least make adjustments knowing this overall. So it wasn't looking at each product, although you needed to look at that too for a different reason. We're just kind of looking at that overall plant evaluation. So it's a good point. I think you definitely want to kind of look at, there's like the big picture and the small picture, but they both kind of relate to each other. And you need to be willing to understand the cyclicalness of your business too. Some businesses, kind of recognizing they say, my business based on my customers is 60-40 or 40-60. Like, I'm always just doing this much business at the beginning of the year and this much at the end of the year. Well, you may want to adjust your overhead rates for the beginning of the year versus the end. Really try to clean up your budgeting principle or your overhead assumptions into how you're running your plant. So anyway, I just want to kind of, because I appreciate what he was saying about kind of, it's not just the point piece by piece, but kind of the overall holistic picture.
Okay, amazing insights there, Bob. Thank you so much. Dave, you had a comment as well?
Yeah, just real quick, I'll add to what Mark and Bob are both saying. This is kind of from my perspective, my experience. This is where standard costing really comes into play. I mean, everything that you guys are talking about is captured with standard costing, and that's one side of it. The other side of it is, I still agree with you, Sam. Not a lot of companies should be doing it.
Okay, amazing insights there, guys. So, Mark, I'm actually going to have one follow-up question for you, and that is going to be about the layer that you have brought in, and that is going to be our favorite topic, which is going to be overhead. And I don't know which gap you were talking about when you were talking about the system, but the gap I am familiar with is there is always going to be a gap in understanding how overhead works. So, in your experience, when you look at the overhead, okay, what are some challenges that you have seen? Because of that, the overhead is always going to be off.
Sure. I mean, it is. It's just a. It's. I don't want to say. I don't want to say random, because it's not random. Like Bob is saying, you put together your budget. You look at historical. How much have I paid for my lighting and my building and my maintenance and everything else, and that's my overhead. Now I want to allocate that, right? So it's not overhead in per se. Overhead's a fact of life, and it is a cost, obviously, that we need to cover with our margins, right? But it's the allocation is where we get into trouble. It's saying that this product, or even this type of product, is going to be allocated such and such a percentage of all my overhead. This type of product is going to be allocated another percentage, and it's like a forecast. It's always going to be wrong, right? And there's nothing wrong with it. The mindset is correct. You want to. It's part of your cost, in the sense it's part of your operational cost. It's where you get down to the product level and looking at your unit cost and including those values, which are fundamentally, by definition, not correct, into your analysis, and making sometimes some very big operational decisions using that information.
Okay, amazing insight. Thank you so much, Mark, for that. So, Chris, I'm actually going to come back to you for the next segment, which is going to be, again, another favorite topic for me. And that is always going to be this connectivity of different systems, when the different systems are going to be hosting different data points. And then you are sort of tying this costing understanding across the systems. So, just because of the communication, have you seen any problems with the costing? And obviously, you are making very big decision, as Mark has pointed out, based on that costing. So obviously your decisions are going to be off. So any communication problem, any stories?
Sure, I've got a couple of those, and I am going to throw out the word variance though, because we didn't talk a lot about that. I think as you think about costing, one of the points I'll emphasize is just to do variance analysis, and what that means is that we make assumptions. Just as Mark is talking about, well, how do you allocate? And you think about allocating the cost of the warehouse. Do you do it based on volumetric? Sure, but I'm only half full, which means it's a dynamic moving element, right? So you got to have cubes and stuff, but there's a lot of different ways to do that. But the one point I want to make about that is there's typically general ledger accounts that capture these expenses that are being allocated as part of the overhead, where now we can measure against the actual cost. And again, it's that variance where, okay, do we adjust, do we tweak? And the goal is just closing it out. So back to systems integration problems. I ran one yesterday. Couldn't believe it. So it's a healthcare system. They run about 20 clinics, and so the caveat there is that at the local clinical systems, they've got inventory. It's funny. Yeah. They order the phone, they purchase, they receive it. The problem in the system is when you receive it at a cost, guess what? That's the new cost, which means anything you have in the system, it's all at that cost. Whoops, that's a problem. You buy it at $1, you buy it at $5, now everything's worth $5. So there's a perfect example where you can't rely on this host system to pass you a cost with a sales transaction. So what's that going to tell you? You're going to have big variances. And one of the approaches that we've done in the past with a couple of clients, and I've had these guys only 20 sites. We have a bigger one that had 1,500 sites. Same problem. Again, no connectivity between the systems, and the systems integration approach that we had is we actually duplicated the subledgers. So again, these are like, imagine 1,500 or even 20 retail locations. They've got inventory, purchasing, doing sales. And when you replicate a subledger, what that means is that corporate is doing purchasing. They're receiving inventory, and the integration point is now into the sales subledger, because you actually want to consume the inventory by the integration versus sending a general journal. And what's going to happen there is that subledger inventory that you've replicated, right? You're bringing in the receipts. So you get a three-way match, which is hugely beneficial, but you consume based on the actual sales transactions in probably a LIFO or a FIFO manner or an average. So you actually get your real costing here. Same thing, you still got to analyze the variance because the journal entry from the clinical system is hitting with one number and your subledger is hitting another. But same thing, in the complexities there, these other systems may not have layered costing. And what that means is that when I buy and receive a product, that the layer is, it's an item, it's a location, it's a date, and it's a cost. Okay, and what that means is if you've got 3 locations, but if it doesn't have a location attribute, the cost can be different between locations because of landed costs, right? I have a lot of shipping and taxes to bring it here versus to bring it here. So again, weaknesses in some of those other systems, but certainly there's some techniques to try to mitigate and again, collapsing and being able to see those variances. So hopefully
Okay,
like
amazing points there. So, we have a very interesting question from the audience, and I definitely wanted to cover that. So, Chris, I'm actually going to ask you, I'm going to read it for you so that listeners know what we are talking about. So, here we are talking about, would you look at profitability differently when you are looking at different types of business? And this can be applicable for different industries as well, which is always my favorite topic, that when you look at the costing could be very different in different industries, and because of that the profitability is going to be very different. And I agree with Scott, his point about commodity versus custom. I think the costing is going to be very different. So what would you say to this, Chris?
No, I agree. And if you think about just different product lines and they're managed differently, you may have different margin expectations with different product lines. For example, services, can you realize a 60% margin on services versus 12% on product? And I think as organizations plan and forecast their P&Ls, they use that example. I was telling you about a guy earlier that makes 60% on licensing and he sells very little service. Good for him. He's trying to maximize that part of the business, but it's an eyes wide open. But certainly the financial analysis can't be macro. We're getting micro, and even variance analysis, whether it's at the P&L level. Hopefully we're clocking time against a production order so that we can figure out that, hey, I got a big variance. If I don't have the micro data, I can't figure that out either. So
Okay, amazing. Thank you so much, Mark. Yeah, go ahead, please.
Yeah, I think it's a great point that Scott brings up, and it's absolutely huge. And frankly, the whole point that I was making is was kind of came from the early 1900s with the Ford assembly line, right? Things are so predictable. It's a standard product or repetitive or commodity product, as Scott put it. It's so predictable. Then that overhead number on a unit cost is going to be dead on. That's not a problem. You get into a custom environment, yep. And people, I think Dave, somebody already mentioned, you don't have a clue what your labor times are. Bob, you mentioned you got to get out on the floor, try to figure out what your times. Folks aren't confident in their times at all, but yet they're making a percentage, calculation to put in overhead on it, to allocate overhead. It's crazy. So that's where you get into trouble.
Okay, go ahead, Bob. You have a comment?
Yeah, I just kind of, again, building on that is I worked in a business where we had both commodity and custom. I mean, all of it was custom business, but we had commodity products that were sold at a very, very low margin and very complex products sold at a very high margin because that was the market value. That was what we could sell it at. So to that end, we did do some real deep analysis on kind of, I'll call it product family basing our allocations. And our kind of overriding principle was complexity. It was like this commodity job doesn't really acquire a lot of anything. People it's kind of the orders come in, they go down to the floor, they get produced, they go out the door. There's very little interaction from a real management overhead viewpoint. Whereas the other complex ones, I have to hire high level engineers, and I've got different supervisors, and I've got different equipment, and the product itself has a much longer life cycle through my plant. So I may, again, with those types of products, have a higher burden allocation to those types of products and kind of try to measure that for success. And again, when it comes down to the line, you're paying the burden, whether you're paying those people whether you like it or not, the overhead. So then it becomes, but then you can start to analyze, where am I in this month? If I need to sell something, go back to kind of Dave's, like that standard costing, I need to kind of be at this level of something to kind of cover my costs. And if all I'm selling is commodity products this month, I may be in trouble. But if I'm looking at those products as they're volume based, as they're going out the door, I can kind of forecast where I feel I might fall even on week one. If I feel like my product mix this month, the only thing I have orders for is commodity, I may be in trouble, but at least I can make hopefully some minor adjustments along the way. So.
Okay, amazing. Great points there. So, Bob, do you want to touch on the question as well? I mean, see, I think we have touched a bit, but I want to make sure that, we are not leaving anything for Scott. So do you have any thoughts with respect to the profit levels?
Well, profit, again, this kind of, we talked about this really early. It's like about market.
Yeah.
But market is subjective when you get into certain areas. When you get into custom products, the market, again, might bear something more than what the product is worth, like what it costs you to make. And I'll give you an example. I used to work in is the driver's license business, because when you're making driver's license blanks for those, it's a whole kind of holistic, it's a huge contract about the person providing, and you're actually the commodity piece, but the value you can sell that to that client because they will pay that price can be astronomical to what it costs you to make. So you got to be careful because you got to recognize, like, you don't want to be like, oh, well, I can make that for $1, so I'll sell it for $1.10 just to make some money. No, it cost me $1 and I could sell it for 2.50. Why wouldn't I do that? So again, you have to kind of know the market. It depends. Again, I was in an area where we had very disparate products. We had, again, this commodity level, this high level. So you have to look at so going back, you have to look at profits differently. Different products will garner different types of results. So it really depends on what you're making, but certainly you want to look at them differently.
Okay, amazing. Thank you so much, Bob. Abu, do you have a comment?
Yeah, so I would tend to differ a little bit with the panel. So it looks like we're saying that commodity pricing, is like commodity costing is easier to do compared to custom pricing, right? So if you're in a commodity business, you're making commodity. You just look at the last 6 months, what has happened to commodity pricing, right? If you had a simplistic view on commodity, on fuel, for example, in the food business, the grain that cost 6 months ago is not what it is today, right? It has changed every month. If you're a chemical manufacturer and you're using fuel, for example, right, the cost structure has changed very consistently over the last few months. So it can become very complicated if you don't have the right costing methodology in place. The costing, the question is asked about, can we compare the profits level between the different costing methodology, right? There's no, I mean, my personal opinion, there's no, relation between the two, right? Profit is profit. At the end of the day, the profit is going to remain the same. What proper costing allows you to do is to make better informed management decisions, right? If you have multiple products, are you making money on this product versus B, A or B, right? It shouldn't be driving your profitability. I've seen at a lot of companies where, they want to report better profits for their preferred product line, right? So they'll change the allocation mix slightly, and suddenly one product becomes more profitable than the other, right? So it happens a lot, but that doesn't mean anything, right? You're still making $1 million, whatever methodology.
These
That would
are
be my opinion.
classic stories. Thank you so much, Abu, for bringing those up. These are the one, that are really fun. So thank you so much. Okay, Dave, I'm actually going to come to you. So for any of the communication related stories that you might have because of the system communication and implications on the costing.
Yeah, I think I'm going to build a little bit on what Chris was saying and kind of go back to my acquisition example, and what Chris was starting to talk about, which is a fantastic point, is the variance, right? And the power of what those variances can show you. And it was pretty clear in acquisition setting when you're talking about a legacy financial system that was not, let's say, implemented with standard costing or really any idea on the costing side. It was, here's what we're selling, here's what our actual cost was, here's our margin. As we started to transition those businesses into the corporate financial side of things and implement that standard costing, when those months started to flip and we didn't just have big buckets of cost, let's call them, and we started to see those variances, that's when all of the real detail work started to begin, because now you're able to go and dive deep into what everybody on the panel is now saying. I was able to see very clearly, where's my problem? Is it labor, material, overhead? Is it how it's being allocated? Is it a product mix issue? Is it a standards issue? Is it a material cost issue? Back to the inventory side of things. So all of this stuff, is very interconnected. And, once you start to implement any of these things, if you're at a point where you're not implementing any of it, just taking some steps to understand what's really happening out on the shop floor and how that ultimately ties into the financials that you do see, or whether or not you're much further advanced and you do have a system that's delivering you variances, and to understand what the impact of those variances are, and then how you can leverage that information to go out and drive additional operational efficiency gains. It becomes pretty key. So
Amazing insights there. Thank you so much, Dave. So, Abu, I'm actually going to come to you. Do you have any stories that you might be able to share because of the system communication problems and impact on the costing?
So all the time, right? So I mentioned it earlier. One of the biggest issue is, for audit purpose, for financial reporting purpose, if you have a bank loan or something, or you're a public company, if you have two different systems, your GL data, your journal entry data, will never match your inventory data, right? So, and when you try to match the two, it will almost always cause a problem. And then just trying to match it, trying to recreate those costs at a certain point in time, that's one of the hardest challenges. And that's where a lot of companies come to us to help them out. And we often like those assignments because it's a lot of hours to fix it, right? So very common. different systems causing the data to be out from each.
Okay, amazing. Thank you so much, Abu, for that. So, Mark, I'm going to ask you for your story related to communication problems.
Sure. So actually, here's where I'm going to tie the product costing in with scheduling. Okay.
Hey.
So here's the thing, right? So if you look at contribution margin analysis, essentially you're taking your, say, let's get down to a product level, right? And Bob mentioned product mix, right? So like what product should we run to have the best performance in our company, our best financial performance? So you look at the contribution margin now. So the contribution is your revenue minus your total variable costs, right? So essentially material and or outside services. That's your contribution margin. That money is is contributing to getting up to your total labor and overhead number for that month, and hopefully you're above that to have some profitability, right? So now if you break that down at the product level, then if you have no bottleneck internally in your production facility, then you simply sort on that number, right? So the highest, if like time in a bottleneck is not an issue, then you sort by that number. Now, this is why it's really important to understand what your bottleneck is, a la scheduling, right? Because now, once you identify your bottleneck, then you figure out how many contribution margin dollars you're able to generate through that bottleneck per unit of time. Now you can make product mix decisions to maximize your profitability in a given time period.
Okay, amazing insights. Thank you so much, Mark. So the only thing we can take right now is going to be closing advice. So Chris, I'm actually going to come to you for your closing advice.
Sure. Thanks, Sam. And so when you're costing, we'll go back to variance. So macro variance analysis means when you start allocating overhead or you've got labor on a manufacturing order, again, it's going to capture those costs in a contra expense account. So when you do it at the P&L level, it's macro variance analysis. Unless you're clocking time on the MO level, you can't find where's the variance at a micro level. So all I'm going to challenge you is just do micro and macro variance analysis. Yeah. You don't have to do micro everywhere. You don't have to clock time everywhere, but you need to identify where your assumptions are wrong in these processes.
Love it. Thank you so much, Chris, for that. Bob, what would be your closing advice, please?
My closing advice, kind of going back to the foundational, is really understand what the process is, how what your costing process is, how it goes into your ERP system, when it goes into your ERP system, kind of the timing, the accuracy, the integrity of that data, just really kind of understanding the process, because then you can make decisions about when can I fix those, and going back to Chris's point, when can I make those fixes if I understand what that process looks like.
Okay, amazing. Love that advice. Thank you so much, Bob. Dave, what would be your closing advice, please?
Yeah, to kind of continue on with what Bob said, it's all about understanding your business before deciding what the best cost approach is. I would also say don't be afraid of standard costing, because it's become very powerful in the right operation.
Okay, amazing. Thank you so much, Dave, for that. Abu, what is going to be your closing advice, please?
Yeah, I'm going to take everybody talk here about how to track costs, what kind of costs. So I'm going to just take a step back here, because we never really talked about is how to cost, right? So is it going to be average lot cost? Is it going to be standard cost? Is it going to be average cost? And that really depends on the kind of industry you're in and the situation. So for example, we can go with standard cost. It is it's a very powerful tool. But if you're planning to go public, for example, in the next 5 years, IFRS reporting will not allow you to do standard costs, right? So then you have to change the organizational shift and mindset to track those costs. So really important to factor that into your decision making early on. Tie that with your long-term vision, where you want the company to grow. If you always want to remain small, then you can use, simplistic costing methods. But if you want to grow, you want to raise funding, then you have to really think very carefully about how to track the cost.
Could not agree more. Thank you so much, Abu, for that. Mark, what would be your closing advice, please?
So I have a lot of books behind me, right? Most of them are on manufacturing. But actually, one of my favorite books is actually on accounting. This is called The Measurement Nightmare. It's by Deborah Smith. It is out of print. It's actually about these concepts that I've been describing, a really strong comparison between traditional GAAP accounting and this contribution margin analysis. In fact, she puts together financial statements based on the two different methods and compares them. So I mentioned it's out of print. It's a little expensive, worth its weight in gold. Short of that, look up throughput accounting or a book on throughput accounting, and you'll understand more.
All right, guys, thank you so much. So that's it for today. If you joined for the first time, this was part of our digital transformation series, for which we meet every Thursday at 5:30 p.m. Eastern. We pick one topic related to digital transformation, and we always have a very exciting panel that is willing to share their insights and wisdom. So make sure you are not going to miss next week's show. We are going to be here. On that note, I want to thank everybody for their time and insights.
Thanks, Sam.
Thanks, Sam.
Good evening.
Thanks, Sam.
Night, everyone.
Thanks, Sam.
I cannot thank our guests enough for coming on the show, for sharing their knowledge and journey. I always pick up learnings from our guests, and hopefully you learned something new today. If you want to learn more about Chris Garadini, head over to turnkeytech.com. It's turnkeytec.com. If you want to learn more about Abu Asif, head over to pennymanagement.com. It's PANNIMANAGEMENT.com. If you want to learn more about Mark Lilly, head over to lilyworks.com. It's LILLYWORKS.com. If you want to learn more about Bob Feathers, head over to bindable.com. It's BINDAPLE.com. If you want to learn more about Dave Chrysler, head over to thechrysler.club. It's CHECRYSLER.CLUB. Links and more information will also be available in the show notes. If anything in this podcast resonated with you and your business, you might want to check other related episodes, including the interview with Cristiano Garadini, who discusses the importance of costing granularity and why it is crucial to understand your product's profitability. Also, the interview with Ram Krishnamurthy, who discusses costing strategies for different businesses and why that matters for ERP implementations. Also, don't forget to subscribe and spread the word among folks with similar backgrounds. If you have any questions or comments about the show, please review and rate us on your favorite podcasting platform or DM me on any social channels. I'll try my best to respond personally and make sure you get help. Thank you, and I hope to catch you on the next episode of the WBS podcast.
Thank you for listening to another episode of the WBS podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.